Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Ben Frasier. How you doing today, Ben?
Doing well. Thanks for having me on, Kirk.
Great. Well, glad to have you on. So we brought Ben on. Really interesting guy, and I think given what's going on in the markets, he's a timely guest. So, Ben, tell us a little bit about your background.
Yeah, well, I'm a chief investment officer at Aspen Funds and been at Aspen for about 6 years. My background prior to that was actually in banking. So I was a commercial banker and underwriter for many years before I kind of jumped into the private equity side of things, which is what Aspen does. So we do a lot of private equity investing in real estate mostly, but I've also done a lot in oil and gas and a little bit in venture as well. And we raise pretty much all of our money, we invest our personal cash in all our deals. So kind of like a family office, but then raise money from accredited investors as well into all the deals that we do. So that's a little bit about what we do.
Okay, cool. So how did you get involved in this space?
Yeah, well, it helps when my father started the company Aspen Funds, and so that was kind of a natural segue to work with them. Never really planned on it. Was kind of making a career in banking, but ultimately didn't want to go there for the long haul, and saw people that were there for 20, 30 years and realized it's probably not what I want to be doing. Kind of already reached pretty far up in the ladder in banking, and wanted to have a little more fun. In the debt side of things, it's a great training ground. You really learn how to break down deals, risk, and the challenge though is you start to think very pessimistically. Everything is the negative, the downside, and so wanted to make a little more money and have a little more fun and join in the private equity side of things.
Nice. So so describe private equities for the listeners, because I think it's interesting. There's a lot of terms which are kind of thrown around, private equity being one of them, which can kind of mean different things. So how would you kind of describe what you do in the private equity side?
Yeah. I'm glad you said that because private equity is used to mean a lot of different things. I'm using it in the most broad sense, distinguishing it from kind of public equities, right, which are stocks, and I think you can buy in the stock exchange. So, we have a podcast that we do called Invest Like a Billionaire, and our whole kind of thesis is the ultra wealthy invest differently than kind of the average retail investor. And just from the brief conversation we had before we hit record button here, I know you are probably aligned in a lot of these things. Where as we started doing more of the research and studying, the pensions, the endowments, the family offices, the ultra wealthy, they were investing very differently than kind of the average retail investor. And the biggest difference is generally in kind of private equity. And I'll lump that as a big bucket, but that would include, real estate, private equity in the traditional sense of buying businesses and operating them, hedge funds, venture capital, et cetera. So that would be kind of the kind of key areas within the broader umbrella of private equity. We're focused mostly on real estate, and that's kind of my background from banking, but also oil and gas, like I mentioned, and a little bit of venture.
So what's interesting, I mean, we can kind of get into the weeds. Let's start with, I mean, you got a few of those. You got real estate businesses, you got oil and gas. How would you go about finding a deal? Like, I don't know, you just pick one, whether it's just real estate. Like, how would you go about finding a deal?
Yeah. So what I think has been so interesting is the institutional investors have been investing in these types of things for decades, right? One of the pioneers of this model was the Yale Endowment. And what they really decided, I think it was about 30 years ago, is let's do an over allocation into the quote unquote alternatives bucket, right? Alternatives being different from, the public markets. And the results were very, very positive. They outperformed all their peers by a long shot, higher returns and lower volatility. And so they really kind of showcased what you can do by getting into the private investments and alternatives. And a lot of endowments and others followed suit. Well, in 2012, the Jobs Act allowed and really expanded the access to these types of investments for kind of the average what's called accredited investors, and those that are, a little bit higher net worth than the average investor, but still the bar is fairly low for a lot of people, especially your listeners, and basically allowed direct investment into these types of assets. And so the access has exponentially increased. And actually just yesterday, it's pretty cool. The House just passed a new bill expanding the accredited investor definition even further. So the trend has been to continue to democratize access to these types of deals. Very, very long answer getting to your question, but how do you find a deal? I think what I've seen being in the space is there's been a massive increase in the amount of deals that people are probably seeing, right? And because of these changes, people like me, Aspen Funds, can now market directly through social media and through Google and other places. And so what's now, I think, been a very cool thing to expand and open up the opportunity set for most investors they didn't have before. Now you have a new problem of, well, how do I distinguish between a good investment and a bad investment, right? Because so the simple way to answer your question is, if you're an accredited investor, you're probably already getting deals sent to you via Facebook and other places because of the targeting that these operators can do. So I think that the bigger question is, how do you define or how do you determine if a deal is worth investing in or not?
All right, well, let's go down that rabbit hole. I mean, we talked before the show about due diligence. So how would you go about determining if a deal is a good idea? How do you do due diligence on it? Like, what's your process look like?
Yeah. So, you said you're a fiduciary, so I'm going to make the caveat here. I'm not giving any investment advice. Obviously, this is just my personal perspective. And what I think is always helpful too is to take a step back, right? Before you write the check for your first, real estate investment, for example, I think it's important to understand, what is your primary goal, right? Is your primary goal to get, current cash flow, to get a check in the mail every month or every quarter and have a consistent payment stream? Or is your goal to maximize your net worth, grow your balance sheet? You want to go from, say, $1 or $2 million net worth to a $10 million net worth, and you don't need the income right now because you have other sources of income, right? So defining your investment goal, I think, is a very, very important step before you even write the first check. But then as far as due diligence goes, I think that alone, identifying and narrowing your kind of field of vision helps kind of identify what are the types of projects I want to invest in, right? Do I want to go and invest in a new development opportunity? Or do I want to go invest in, kind of more core plus real estate that's not as much total return, but you get a little more cash flow and a little more safety, right? So it's kind of defining what is the risks and the returns that you're trying to hit. And then as far as due diligence goes, I have a really simple framework that I think about when I'm investing and whenever I'm looking at a deal to bring to our investors and invest our own money into. And it's really, there's kind of three parts of an investment, right? You think about, horse racing, for example, and I'm not into horse racing, but this is the idea I came up with, so that's what I got. But basically, you got three components. You've got a racetrack, right? And that is the market you're investing in. That's the asset class you're investing in. It's kind of the broader picture of, are you investing, for example, in multifamily in Texas in a Class B value add opportunity, right? That would be the racetrack that you're investing in. And then you have the horse, right, on the racetrack. And the horse is really more of the strategy. So within that kind of market and asset class, what's the strategy, right? Is this a value add strategy? Is this a new development strategy? Is this a repositioning of another asset to a new asset class? And then the third piece would be the jockey, right? And that would be the operator in this case. So who's actually behind the deal? Who is operating the deal? What's been their track record? What's the management team's experience? Are they vertically integrated or not? And these are the kind of just simple checklists of things you can kind of run through. And of those three, right, a lot of people think the track is the most important. I would say understanding the broader trends and markets are very, very important because that kind of creates the kind of ceiling or the universe you're playing in. But the jockey and the people behind the deal is what I would argue the most important of any of those three.
Yeah, no. So let me ask you this. I mean, we talked about the show before the show that you kind of have more of a top-down viewpoint. Um, how do you look at this market and where we are from like a high level and apply that to some of the assets that you're talking about? I mean, I would argue at least one of the assets that you'd mentioned from a macro perspective is not great. So how would you kind of apply that practically?
Yeah, absolutely. And I think, like we said before, the our kind of approach is really a macro driven approach, right? So I made the argument that jockey is the most important, but I'm gonna go back and say, it's also very important to understand the economic trends behind where you're investing, because that creates the tailwinds or the economic tides that will help let all boats float, right? In a rising tide, all boats float. And so we want to invest where there's more margin, where there's tailwinds that are going to help make a deal more successful, right? Because when you're looking at on the front end of a deal, you're doing the underwriting, you're trying to project what the returns are going to be. You're making a lot of assumptions, you're making a lot of guesses, and when you have margin, when you have tailwinds, it makes those guesses, it makes it a lot easier to have a more probable chance of success. So, from a macro perspective, we are seeing in commercial real estate, there is some big headwinds, some big challenges at a whole level, primarily from interest rate increases. And, we've seen some of the fastest or the fastest interest rate increases in recent history. And when we've had such cheap debt, and what I would also argue is a syndicator bubble, right, where every Joe and his mom that thinks they can raise money is going and investing in these deals. It's created a very frothy market, especially in some of the more Sunbelt markets, where I think the values got driven up way higher than they should have. And you add on to that, purchase with bad debt, right? So one of the biggest things that we focus on when we're looking at deals is the capital stack, understanding what does the debt look like, what are the terms, who are the counterparties involved, and really understanding the risks there, because most deals don't fail because of a lack of top line revenue. I think there's a lot of demand for housing long term, as even right now. But most deals are going to fail because of poor capital structure.
So you'd mentioned some of the challenges for commercial real estate, and I think from everything everybody I've talked to, many of which on the show, you're looking at office space as kind of probably the worst area to be in. But in commercial real estate, there's obviously a lot of challenges. How do you invest in a space where it's the buyers and sellers aren't necessarily aligned in a way that is let's just say preferential for the buyer?
Can you elaborate on what you mean more by that?
Well, if I look at, for example, the residential market, I am only saying this because I have the numbers off the top of my head. The residential market in 2021, you could get a 2.5% 30-year mortgage, and the prices are whatever they were. Let's say it was $500,000 for a house. And 2022, home prices, the median home price went up 10%, which would bring it to about $550,000. And interest rates have gone up from 2.5% up to right now they're close to 7.5%. I think they went to 8.25% a week ago. So that's doubling the monthly payments. And I don't know off the top of my head that the 10-year for commercial real estate, but there's probably some similar trend there. And so you have higher prices and you have less affordability. And you could argue whether the peak was an equilibrium, whether it made sense or not. But either way, we're still way off the mark. So presumably commercial real estate is in a similar place, or at least was. I don't know where it is now. So that's what I'm kind of getting to, is how do you get it to where it's aligned, where it's actually a good buy, as opposed to just, hey, I have to put money somewhere. Let me throw it in this deal because it exists, not because it's a good deal.
Yeah, absolutely. Okay. That's a great question. I think one of the things is helpful to break down, right? When you say commercial real estate, we're lumping a lot of things into one category that should be differentiated, right? I think you should differentiate by asset class, because office, to your point, is, I think, headed for a really big disruption. And I know people that are, being contrarian and going investing in office. That feels pretty ballsy to me. I feel like it's still pretty early to know where that all kind of plays out, right? And the argument is, well, I'm buying it at below replacement cost and a really really low basis, but maybe you're catching a falling knife. I don't really want to be playing that game. And then you have housing, right? Both multifamily and single family. But you also have industrial, you have storage, you have mobile home parks. There's a lot of other kind of subsets of commercial real estate. And when you break them down, each of those has performed very, very differently. And so when we're looking for opportunities, right now it's challenging because the interest rates are higher for sure. But in a lot of ways, a lot of the deals that were done over the past few years probably shouldn't have been done if the interest rates were maybe a more normalized kind of world. They probably wouldn't have been done. And so there's still a good value to be had. The big challenge, which you may have been alluding to, is there's not a lot of transactions happening right now because sellers don't want to sell and realize a loss, and buyers don't really know how to underwrite right now because interest rates have been moving so fast, and so it's created a lot of just slow down in the market overall. But I think we're going to start seeing that pick up as maybe the bid ask spread narrows over the next 6 months of this year. And I think one of the challenges in private equity real estate, right, in the private markets, is they are generally lagging, from a market value standpoint, the public markets, because it takes a little bit longer for those the bid ask spread and the transactions to realize to set kind of the new price. So all that to say, we are, in some ways kind of taking a unique approach, because as we're evaluating a lot of the deals and the strategies that worked a couple of years ago, which I would consider, you kind of have your core plus and then maybe value add is kind of the next step up. You're taking an existing property, maybe an older property, but it's in a good market and strong rental demand, and you can renovate the property, renovate the units, make it look nicer, rent it for a higher premium than they're renting right now. And you can force appreciation by doing that, right? You force the value of the property higher because you're increasing the operating income. And commercial real estate is priced off of a multiple of cash flow, right? Just like businesses. And so you can force appreciation, but then the challenge becomes, well, what multiple do they trade at now, right? And what we saw is over the past several years, because of this kind of syndication bubble and cheap money, it drove down the cap rates, or drove up the prices pretty significantly, to where in some markets, like in Texas and otherwise, you were seeing deals traded at a 2% cap rate, right? So you're basically you're buying existing cash flow at a 2% cap rate, which in my mind, you're basically paying for the future value of an asset now, and you're taking all the risk to achieve it, right? That to me is what you're doing. So what we've actually seen is what I'm calling an inversion of the risk curve, right? You've heard the inverted yield curve, but I've actually seen an inversion of the risk curve. And in certain cases, in certain markets, development actually makes more sense than value add, right? Because where there is a shortage, where there is still pent up demand for housing, for example, because we are doing multifamily development as well as industrial development, you can build and you can create a lot more margin by developing than you would from buying an existing asset and repurposing it. And you're kind of taking a lot of the same risks, right? Where in the value add, kind of repositioning deal, you don't have much cash flow anyway during the kind of renovation period. And you're taking a lot of, risks with older properties, et cetera. So we've actually shifted more to development deals in the past kind of 6 to 12 months. And we're also shifting outside of just multifamily. We've been doing several industrial deals, and we're very, very bullish on industrial right now. I can get into some of the reasons why, but that's kind of where we're finding opportunity.
Yeah, no, I've I've been seeing that 2 cap rate in Boston for many years before 2020, and I would shake my head at people who are just throwing money at it. And they had to, right? I mean, that was the thing. They
Right.
had to put money somewhere. So you have this money, where are you going to put it? Well, I can either not take the money and not get paid on it, or put it in the 2 cap and get paid on it. I mean, it was silly, but that's what was going on. So are you still seeing those kind of cap rates, or where are things now in comparison to where they were like 2, 3 years ago?
Yeah, we've seen cap rates, I say, as a whole expand probably 50 basis points, right? So they're trading at a 0.5% higher cap rate. But to your point, interest rates have gone up, 100% or more. And, how much does that impact the cap rate? I think that's what kind of remains to be seen. What we're still seeing in certain sectors, storage is an example, especially kind of newer vintages, newer, more class A, kind of more, core assets. They're still trading at very low cap rates, but what's happening is a lot of these buyers are purchasing them without debt, right? Because if you're buying at, say, a 4 cap rate, right? I have a friend who's a large self-storage operator, and they're thought, hey, man, we're going to start seeing deals start trading a much better basis. We can get in some good value. But these REITs that have raised a ton of money over the past couple of years, these private REITs, are sitting on a ton of cash, and they're in the same boat now, right? Where they've raised all this money and they need to deploy it somewhere. And if they go and buy a deal at a 4 cap, for example, they're going to be in a negative leverage situation, which means their cost of debt is going to be more than the unlevered cash flow of what you're purchasing. So they're actually buying them in all cash with the expectation to hold until interest rates come down, right? So they're making basically a bet that interest rates are going to come down over the next few years, and then they can hopefully increase the income through whatever plan they're going to achieve. So what's interesting is you kind of have these two massive competing forces on prices in the commercial real estate market. One, you have debt, which, like I said, has increased 100% or more over the past year. So borrowing costs are through the roof. But at the same time, you still have a massive amount of demand that is kind of sitting on the sidelines. And so I'm kind of making the argument, if we do go into a recession, which I say probabilities are higher than they were even 3 or 4 months ago, it's unlikely it's going to be a 2008 scenario because we're not oversupplied in housing, and there's so much demand. There's more cash sitting on balance sheets than there ever has been, thanks to the government, and it's hungry capital, right? So I think we are going to see some reset, some definitely some price declines in certain assets, but it's probably a healthy reset that the market needs to kind of get back to normal trading.
Nice. Now, you mentioned a lot of, I mean, we're talking mostly about real estate here, but that's, to me, one of the more interesting ones. So you mentioned storage and, industrial and those things. And I think that was, from all the people I talked to, that was pretty attractive even in 2020 during COVID. That was one of the more attractive areas. And obviously there's areas like, office space, which is, I think everybody agrees, is just I think the term was a fly looking for a windshield. I think as somebody quoted that before. But are there any areas that you just feel like outside of like storage and kind of industrial that are just like, wow, these are really great opportunities now? Or are you kind of looking at it as hey, let's wait till things shake out and then we see this is the place we'd want to be?
Yeah, within real estate, our number one asset class right now is industrial. And so if you break down, like there's a lot of reports that show what's the estimated price declines, from the peak of each real estate asset class. Office is the biggest by far. Some estimates are as much as, 30-40% price declines. Multifamily, it's probably 25%, but that's probably more Sunbelt markets that were trading at these 2 and 3 cap prices. Here in the Midwest where I'm at, we generally don't see that much volatility. And then you look at industrial, and it's not that far off, value estimates from where it was a year or two ago. It's maybe down a couple percentage points. And part of the reason for that, we've had a great run in industrial, and a lot of people say, hey, the e-commerceification of the world has been very good for industrial, right? Because Amazon needs warehouses and distribution centers. And while I'm still bullish on that trend to continue, it's definitely plateauing, right? The percentage of retail sales that's being overtaken by e-commerce is slowing down. So that's had a great run, but what's actually happening now, and we talk a lot about this on our podcast, is this reshoring trend, right? So kind of in the post-COVID world, a lot of these companies and manufacturing companies are redoing the math to say, hey, we all experienced a major supply chain bust and kind of underpriced the supply chain risk, if you will, and want to have a little more confidence in being able to deliver a product to the end consumer without being reliant on Taiwan for the little chips that go into the Ford trucks, for example, right? They've been sitting on, I think it's close to $5 billion of inventory that they can't sell because they don't have the chips needed to complete the truck, right? So it's manufacturing is what I think going to have a resurgence here in the U.S. Nearshoring, you've probably heard the term, where our kind of U.S., Mexico, and Canada trade relationships are projected to really blow up in a positive way as we're kind of reallocating some of those trade relationships. And so positioning in areas that are going to have kind of a manufacturing resurgence is, we think, a very good place to be. China has been kind of the manufacturing place for so many years, so many decades, right? When I was in school, the just in time inventory and globalization were the hot words, but it's really kind of having a reversal because the wage growth in China, as an example, has increased by 15x over the past 20 years. So just 1,500% increase. And so the marginal costs now to manufacture back in the US or in Mexico are becoming less egregious, and then you can have more control over critical components that are needed in these certain things. So all I had to say, about $1 trillion of reshoring activity occurred in 2022, and most estimates stays kind of the very beginning of a big secular trend. So that's an area we really like. And then outside of real estate, we're very, very bullish on oil and gas investing, which I don't know if we want to get into that, but that's something that we're looking at as well.
Yeah, I do. I just want to hit on this one more point before we get into your other assets. So the nearshoring. So one of the things we've been talking about in the show a lot is the deglobalization of supply chains, right? It used to be, as you said, everybody's outsourcing to China and to cheaper labor markets. And now, because of the China issues, in large part, but not entirely, we're reversing that trend to deglobalization, which is, as you said, nearshoring. So I guess, the question I have is all of that takes time, right? Yep. And I've heard different estimates from different people. How long do you think it's going to take before the markets kind of settle? The nearshoring has been done for the most part. I've heard it takes, somebody was telling me it's going to take 5 years from kind of when the start of that is before these companies can build a factory. So what are your estimates and also it plays a lot into inflation, right? Is this the deglobalization plays a lot into our inflationary problems. So what do you think are kind of estimates for when that'll be kind of settled, where we have more diversity in our supply chain, where people are like, all right, like this is more of an equilibrium?
Yeah, I mean, it's a great question. I think it's going to be a while. I mean, I would say to probably fully realize this reversal of the trend, it's going to be at least a decade, I would say, because these are big decisions that are being made by the big Fortune 500 companies that are, redefining their whole calculus. And, these are hundreds of millions, if not billions of dollars worth of decisions that they're making. So it's going to be slow, but we already saw $1 trillion just last year in kind of reallocating funds toward bringing more inventory back in the U.S., right? Because there's kind of multiple things to distinguish within the reshoring trend. You have manufacturing, which I think is going to be a lot slower. Then you have reshoring of inventory, right? Re-inventorying. And so just holding more inventory is a lot simpler. You can build these, big concrete boxes pretty quickly and start to just hold more inventory, right? Because part of the challenge is, just in time inventory system where you have a perfect supply chain, you hit the button and, you get something from China that's, gets delivered to the coast, gets, across the ocean and right when you need it, right on time. But as we realize, that doesn't work anymore. And so we need to hold more inventory, especially of these kind of critical components. So I think the inventory is going to be a bigger part of that early part of the wave. And then the manufacturing is going to be kind of the later part. But that also plays into, the energy kind of piece of this, and inflation is, we think inflation is going to be higher for longer. And it sounds like you may be in that camp as well, because, deglobalization is very inflationary, right? And that's going to continue to keep inflation higher. There's already a labor shortage right now in the U.S., and I think that's going to get exacerbated even further. And then the other big component of inflation has been energy costs, right? And we've had, more suppressed energy prices of the past 9 months or so. But, we can get all the supply and demand if we want, but there's been a massive underdevelopment in the U.S. of investing in new production, which is required to just maintain production levels, because, oil and gas are a depleting resource. So every year we deplete about 5 to 7% of the domestic production. And so we have to be reinvesting in the investment back into new production has dropped by over 50% since 2014. A lot of that's being driven from the ESG movements and other things. And so, we saw last summer as kind of a big spike in oil prices and gasoline. We think that's going to become more frequent as we have a lot more supply constraint, because it's very difficult to just flip the switch and turn on more production. And how that plays into kind of reglobalization and reshoring is a lot of these countries, not even outside of the U.S., like in Europe, for example, they don't have a lot of energy that they can rely on locally, right? And so they have to import it all in. And energy, especially in a heavy manufacturing business, it's the biggest expense that they're going to be paying outside of labor. And so they want to be in a place where they can have good energy sources and prices that are not going to be as wildly swinging as, in Europe, where natural gas is, gone up 5x.
So before I get into the oil and gas space, which I do want to talk about, I did want to briefly touch on the private company side. One of the questions that I have, because private equity has been a big deal for, I don't know, 15 years, something like that. It's been a really hot trend, and everyone wanted in. And, and I think it was maybe 5-7 years ago, I was talking to a few people who run some private equity funds, and I asked them, I said, so what are you investing in the private equity? I said, I wouldn't put my money in any of this stuff. It's just so overpriced. And, we had a long conversation. Of course, they're raising capital, but they wouldn't put their personal money in. So it kind of raises this question, because private equity is not necessarily accurately priced. It's not pricing to like the public markets are, where you get a price any second of the day. It's not necessarily accurately priced. So can you explain how that works for people? Because they see it and they're like, oh, I made another 15% this year. And it's like, did you? I don't know. Like the pricing mechanism is a little bit more, little more guarded, let's say. Maybe you can kind of talk about that a little bit and what that looks like in the private company market right now.
Yeah, you're talking specifically about private equity as it relates to buying businesses versus real estate.
Yeah, businesses. Yeah.
Yeah. So to be clear, my background as it relates to that is more limited. So I've been more on the real estate side of things. When I was a banker, I did do a lot of M&A transactions. So I've seen it. I've seen how they work. A lot of times it's similar to real estate. You're purchasing it at a multiple of cash flow, a business, and you're leveraging it up. So the leverage buyout, LBO, is a common method to do that. But I would kind of go play both sides of this, because you're right that price discovery is difficult, and realizing returns is also, you don't really know where you're at till the end of the day, right? Because a lot of these companies, they're not doing fair market value adjustments throughout the life of a fund. So maybe some of them are, but for the most part, it is a little bit more opaque, and I think that can scare some people. But in the private markets, your multiples are generally a lot lower than public market multiples, right? So a price to earnings ratio is an equivalent to what you're basically buying the cash flow for in a private market. And generally, depending on the type of business and the moats they have, how scalable it is, they're going to trade anywhere from, say, a 3x EBITDA multiple, anywhere to, if it's tech, maybe a 20x, which is be on the very high side. But for the public markets, the PEs, I mean, they're generally going to be the much higher end of that range, if not above that. So you're paying a lot more, in my opinion, for liquidity premium, right? And that's generally what the delta is related to, is it's the illiquidity discount. And so, in true private equity, I'm always looking at I've not invested a lot in personally, to be perfectly frank, but to me, it's all value based. And what I like about like real estate, for example, when you're doing these kind of forced appreciation strategies, you have to a certain degree a high level of control over how much value and income you can create, right, based on your business plan. And then the question becomes, what's the market going to pay for that? So that definitely fluctuates, but we haven't seen massive changes in those cap rates over the long haul. I mean, it's mostly been trending down, for a long time. Maybe we have a blip here, but I think over the long haul, there's a lot of demand for it.
Okay, cool. So I want to touch on the oil and gas space as well. We had a few guests on to talk about the oil and gas space and some of the challenges that are happening there. Can you talk a little bit about what trends are going on there? Like, what are the hot trends? What's doing well? What's not doing well?
Yeah, I already kind of gave a precursor to a lot of our thoughts, but ultimately, we're pretty bullish on oil, especially because of the supply constraint, right? And so, if we're depleting 5 to 7% of our production every year, we're not replacing it. That's just reducing supply, and it takes a long time to build out a drilling program and really start to boost production in a short period of time. And so what's kind of happened over the past several years is, as the ESG movement has caught momentum, which is basically disincentivizing investment into traditional fossil fuels, as well as a lot of the political pressure where a lot of these politicians are going to banks and creating challenges for them to lend. And then on top of that, you've had a lot of volatility in the market over the past several years, right? We actually had oil prices went negative for a short period of time, which that doesn't seem to make sense, right? And so it scared a lot of private equity, and so there's been less investment and there's been less capital provided and available to these companies. But the bigger issue is we are very reliant on fossil fuels, and we don't have to get into the whole political argument of renewables, and the viability of that. I would love to be 100% on renewables. I think it's a great goal. I think it's something that we should continue to push for. But most of the goals that are set by the EIA and the kind of benchmarks that we're shooting for are completely unrealistic. There's just no way that we're going to hit them. And I think people are not really looking at the numbers and what it's going to take to get to these goals. And so what's going to happen is, I don't think it's a great conspiracy to think that, hey, let's try to disincentivize fossil fuel production so that we can push more capital and resources to renewables. And hey, if prices go up in the short term and that causes a demand destruction, where basically you're reducing the demand because the prices are higher, we're okay with that, because that's only going to further what we're trying to do. So that's kind of what we're seeing right now. I think we're in the early stages of that. There's a lot of economists and others that have been in the space for a long time that are projecting very high numbers for oil. I want to operate in a level of conservatism and make deals that work on today's pricing and even much lower pricing than now. But I think those are the big trends we're seeing going on, and something that we're positioning our personal portfolios, through the investments we're providing and investing in ourselves to take advantage of that.
Yeah, I think that concept you just talked about is what we call bad economics. Instead of trying to make energy cheaper, they're trying to make cheap energy more expensive to solve the problem of getting into clean energy. So we're not going to make clean energy cheaper. We're going to make dirty energy more expensive. Yeah. What could possibly go wrong with that? That's totally,
that is also very inflationary too, which
yes, that's what we call bad economics. Too many people in academia that don't spend time in the real world that, oh, really? I mean, poor people are going to have more, they're not going to be able to feed themselves because their energy prices doubled. Yeah, no, that's not a problem at all. Don't worry about
that bill.
So I did want to kind of bring this up before we wrap it up. You're doing a lot of deals, and you mentioned due diligence earlier, and I did want to get into this. Can you talk about maybe a situation where kind of a deal went bad and how you dealt with it, and maybe how you would look at kind of correcting a deal that maybe you kind of got into an error?
Yeah. Well, all my deals go really, really well. So
of course they do. Yeah. Hypothetically.
Hypothetically. We've definitely had some ones that struggle, right? And that's just the nature of investing. You're going to have deals that don't go according to plan. What we do, we kind of operate in, like I said, more of a family office approach where we're not always the lead operator, but we negotiate and structure deals to where we have certain rights that we can exercise if an operator is not performing to our expectation. And then, we do asset management in-house and make sure the deals are hitting what they need to hit. So we have one deal. It's a redevelopment of an old retail strip center into a climate-controlled self-storage facility. It's a project I'm super excited about. It's really, really great, just numbers and the area. But we come to find out that our lead operator, and I don't think he was completely withholding it, but he wasn't being completely forthright in that he got Lyme's disease, which is a very, very serious disease. And he got pretty much, incapacitated for months. And we didn't really know. We didn't hear from him what's going on. So we had to step in and basically drive this project, forward and, take over the deal in a lot of senses, because we didn't have confidence that he could perform on that. Right. And so, one of the challenges with passive investing and, just investing in general is you're kind of, giving away the rights to the people you're trusting to run the deal. And so you want to have confidence that they're going to be able to perform on that. So, in that particular deal, I wouldn't say it's going poorly from a performance standpoint. The numbers are all intact, but it is a deal that, we didn't plan on having to jump in and kind of save the deal and push it forward. But, sometimes that's what has to be done, and, allocate more internal resources to do so.
Yeah, no, that's good to hear. I think a lot of people, when they think of passive investing, they just think, oh, I just push a button and it's easy. And I think stock market is about the only place that's passive, if you want to call that passive.
Right.
Really are. A lot of deals aren't passive, but people have this illusion. Cool. So before we kind of wrap it up here, any final thoughts you want to leave our listeners with of things that they can take away from this to learn about, investing in private equity or otherwise?
Yeah, I think, I love what you're doing, and obviously the education you're providing. I think so much of what I find, and when we talk with investors and even, folks that work with financial advisors or fiduciaries, it's important to have as much focus on preserving and growing your wealth as you do on earning your wealth, right? And what I find so many people, they spend their whole lives and their whole careers maximizing their salaries, their take-home pay, the options, the equity, and trying to make as much money as they can. But then it's just a complete, turn around and just hand the keys to the kingdom to a third party that, maybe they're well aligned and they're good at what they do, but regardless, they're never going to care about your money as much as you do. And I think it helps everybody, both the, service providers, the fiduciaries, as well as the investors, to take more ownership over your money, right? And learn how to do due diligence, learn how to vet deals, learn how to construct a good portfolio, learn what are the differences between the different things we're talking about, value add versus development, what are the risks you're taking. And by taking more ownership and control over that, you're going to get better returns. You're going to probably learn a few things. You might make a few mistakes, but over time, I think it's gonna help you be a better investor. And that's why I love what you're doing. And that's kind of the whole goal of our podcast, is to help people become better investors.
Right. Well, Ben, I really appreciate you coming on the show. Where can people find more about you?
Yeah, our podcast is thebillionairepodcast.com, Invest Like a Billionaire. And our private equity firm is aspenfunds.us.
Awesome. Well, Ben, I appreciate you coming on the show and sharing your wisdom with us. Probably have you back in the future, because I'm sure things are going to change. And always interested in having good guests on. So thanks again for joining us.
Thanks, Kirk. Appreciate it.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute. But before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist, because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Ben. Appreciate him coming to the show. Love this area. I think we're going to keep coming back to this over and over, because this is one of those trends that you're not hearing a lot about. It's hated, but it is a very solid trend that's not going away. So let's dive into the panel portion of the show. We have our very own Doug Heagren. Hey, Doug.
Good morning, Kirk. How are you today?
Glad to have you back. And we also have our very own Phil Weiss. Hey, Phil.
Hey, Kirk. Happy to be here.
Yeah, glad to have you here. So let's just dive right in. Doug, what were some of your takeaways from the interview?
Well, obviously he's talking about investing in an area that a lot of people don't necessarily have the same access to, right? And he talks about focusing with the high ultra net worth, but how they have started to reduce the barriers of entry to that through changing some of the rules of credit investors. I'm starting to bring that down to a scale that allows more people to have access to. A lot of it's like what we've talked about previous conversations, some of our conversations we've had on Fridays, where real estate. There's so many changing trends right now. Inflation likely here to stay for a number of different reasons. Some of it again still dealing with monetary M2 money supply, especially with regards to real estate. When you start talking oil and energy, you've got both, actual supply issues, but also geopolitical created supply issues. I think they're going to be facing for a long time, and the impact of that. And also, I think I liked how you touched on the disconnect sometimes between what things are worth on a secondary market when you see them in your account trading different ways, and obviously what they could be worth when you're actually shaking hands and handing money between two people on the private placement market. And I think gold is a example of that he didn't get into, but that's another thing where people are like, well, gold is worth this. Well, yeah, it might say it's worth that on the futures prices, but that's not necessarily what it's going to be if you're trying to go to someone and buy a bar of gold off them. So I think understanding a little bit more about how private valuations work with regard versus secondary valuation, I think that was really important detail. But as I said, overall, in summary, a lot of things we've been talking about: high inflation, interest rates, impact of real estate. These problems are not going away. They're creating opportunities, but they're not going away anytime soon.
Yeah, I totally agree with that. So, Phil, you're a resident oil and gas expert. What were some of your thoughts from the interview?
So his comments about oil and gas were interesting because some of them are things that people often don't think about. We want to get it. There's so many people that want to get us off this carbon standard, right? And let's have more electric vehicles and all that because of the environmental impact. I understand all that, but what people don't think about, and kind of Dan alluded to, so it takes 15 to 20 years to turn over an auto fleet. So it's not like it's going to happen overnight. We're not going to just have everybody turn in their cars, their gas-powered engines, and get a new car that's got an electric drivetrain. That's just not going to happen. And we have states like California and Washington that have put some rules in. I think it's either 2030 or 2035 that they're going to not allow you to buy any more gas-powered engines, but that's a ways off. And the underinvestment that he talked about, it is pretty dramatic. The shale oil that we have in the U.S., that you can bring online pretty quickly. Although, because it's been going for a few years, the way that those wells work, they start at the sweet spot. And as they move out further and further away from that sweet spot, the production's less. So they can't just replace the production. Oil is a declining asset, so it's actually got a curve. And so production is high at the beginning and it falls off over time. Shale wells, it's a much sharper fall. But we've had underinvestment because, like, one of the things that I think about was when I cover the sector, everybody was spending money. And the market came down hard on these companies because they didn't have free cash flow. Right? And you had companies in the sector that they didn't worry about it. If you think about your fixed costs and your variable costs, the variable costs being the ones that change with production, your fixed cost being whatever is sunk in that you can't recover and it just gets allocated over the units. A lot of companies were trying to produce just to cover their variable costs. So they were losing money, but they did it anyway. And the markets made companies think more about free cash flow, which is kind of the difference between your operational cash flow and your capital expenditures. And that's made them cut their spending. And therefore that has a big impact on production. And then we have the geopolitical events that have caused further production cuts. So those kind of things can drive oil prices higher. And we're seeing some of that. It goes up and down, and I'm never going to try to forecast it. I've told you this before. When I was an analyst, I had to forecast oil prices as part of my job. And I would get calls from the media people and they'd say, so Phil, what's your oil price forecast? I said, so here's the thing. Part of my job, I'm supposed to do this. So I'm going to give you a number. And now I'll tell you there's one number that I can just about promise you it's not going to be. And that's the number that I just said. I did that for 7 years to 28 quarters. I hit it on the nose once. And that was just luck because I can't forecast geopolitics. I can't forecast what's going to happen when you have sovereign nations that their economy is driven by oil. So they make decisions that aren't rational in the normal supply and demand world around what they're going to do with oil. So there's just too many factors. We like to blame the oil companies for the price of the pump because everybody sees like, I'm paying more at the pump. I'm paying more. We want to blame the oil companies. They don't set the price of the oil. They can have an impact in terms of what they invest, but they don't set the price of the oil. The futures market sets that.
Yeah, it's interesting. It kind of comes back to this point I've made for many years is I won't invest in oil prices because it's a political commodity. I don't know how people do it. Some people do it for a living. They do it well. I don't get how they do it, but the macroeconomists somehow have it figured out. But maybe they don't, but I guess in listening to a show that actually talks about oil and gas a lot, he almost rarely gets it correct, even though he's a pretty smart guy. So I guess it makes a lot of sense. Let me ask you this, Phil. You know, when you're looking at the trend of oil and gas right now, right? There's a lot of people have been saying that there's a severe underinvestment in the oil and gas space, and you know, I think if you look back in history, there's a strong correlation between prosperity and cheap energy. And the more cheap energy, or the cheaper the energy gets, the more prosperity we tend to have. So, you know, with the underlying factors of the oil and gas space right now, like naturally, what does that lead to, right? Like, what is going to cause oil and gas to remain low, or will it? Or is this just going to be, this is the lowest it's ever going to be? Like, what are your thoughts?
It's a good question. And that prosperity, also think about how many things we think about oil because it makes gasoline, which goes in our cars, but oil goes into plastics, oil goes into petrochemicals, oil is involved in fertilizer. So there's so many things where we're using some type of hydrocarbon. So the higher those prices get, that does impact prosperity. I think it's a very fine line right now, because you've got the need for investment, but you've also got the environmental impacts, and you have a lot of ESG, a lot of people that want to reduce our carbon our carbon output because of look, June was the second hottest month we ever had, and July was the hottest. So whether or not that is a long-term trend or not, I can't say, but we do see temperatures rising. So feels like there's some impact that carbon's having on the environment. So you've got these counterbalancing factors, and it's hard to say where we're going. I mean, I don't think we're going to get back to, if I go back to when we had lower oil prices over the last couple decades, you know, we got into the $30 range. I'm going to ignore when the futures market turned to negative, because that was like an aberration to me. But if we look at like the regular price, the $30 numbers seem like that was the low. I don't know that we'll get there again. I don't know what the ceiling is. Just like anything else, momentum takes these things way further than they should in either direction. But it feels to me like the floor is probably in the $50 to $60 a barrel range. Where the ceiling is, it just depends upon how crazy the market gets.
Yeah. No, I mean, it's you know, it's something I'm always thinking about, because you're talking about like you said, a massive underinvestment in capital expense. And, you know, basically, you know, for the last few years, we've been eating our seed corn. For those of your farmers might understand the reference. You know, in the future, we have less invested, which means higher prices because you didn't invest back the profits back into the sector. I don't know. To me, it's a big question mark, because, you know, like you said, there's a misalignment of goals. California said no more gas cars in the next 5-7 years. Yet there's a 15-year cycle for auto manufacturers. On top of that, you know, we don't have. So I saw an article the other day that was actually looking at the numbers. We don't have capacity for electric cars, you know, to be met right now. We don't have the infrastructure. We don't have electricity. We don't have the number of cars. Like, all these things are just way off base for the goals set. And it just kind of brings up a question of, you know, I have this, like, in the back of my mind, I think of like mental models, right? And one of the mental models is a free market determines the best course of action, right? Which is not one single person or one small group of, you know, wealthy, you know, people who are sitting there saying they know better than everybody else, but like a market is everybody deciding that this is the best course of action. And, you know, when you have manipulations in the market due to different things, it causes distortions, which tends to cause problems, right? So it's like, you know, Doug and I joke about this, because in one episode on a Friday, California came out and they said, we're going to have all cars are going to be green by, you know, all electric cars by, you know, 2030. And the next day it came out and said, you can't charge your electric cars. We don't have enough electricity because it's really hot out here. And it was like, you know, that's right there. You couldn't have a more clear distinction of the problem, which is there's a disconnect between timelines. I don't think anybody disagrees we should have a cleaner planet. I don't even think that's the argument, although people make that argument. Everyone wants a cleaner planet. The question is, how do you get there? How important is it? What are you giving up to get there? Are you willing to spend $10 a gallon, $50 a gallon to get there? I mean, maybe that's what it is. Or maybe you don't. Maybe you want to get there more slowly. I don't know. I don't know what the right answer is. But I think when it comes to economics, there's always a give and a take, right? If you want something, you have to give up something else. There's always an exchange of resources for that thing. So, in your experience, Phil, and I know you may be a little disconnected from this, but the oil companies have been taken on the chin for like the last, I don't know, 5, 8 years, 5, 7 years when it comes to the green movement. And, there's even people on the board who are saying, oh, you need to clean it up. What happens to these oil and gas companies if, everyone goes electric and what have you? Like, what do they have a strategy in place to actually stay in business, or, are they going to adapt, or are they just strictly like, we're sticking to the model?
That's a really good question. And I think back to, there's an old book by Clay Christensen called The Innovator's Dilemma. And in that book, he talks about how today's leaders are rarely tomorrow's because they're always trying to protect their turf. So I think of that. And to me, it says, even if these companies survive, they're not going to be leaders in their space anymore. I will tell you, like, especially the European companies like BP they have wind, they have solar, much more so than the US based companies do. I think the foreign multinational oil companies, integrated majors, have done a better job of having some exposure to some alternate energy. But I don't think that I'm hesitant to invest in oil and gas from a long-term perspective because I worry about that very thing that you said. What's going to happen to these companies as we make that transition? I mean, we do have to think about, though, you have an electric car. Where's that energy coming from, right? It can come from wind and solar, then it's still clean. It could come from hydro. It could come from geothermal, but also natural gas. I mean, we use a lot of natural gas. I'm going to leave out the oil, but we have to be able to generate that electricity. So like right now in the environment that we're in, I don't know that we're really having electric cars and doing as much for the environment as you think, because you still have to generate that electricity. But the short answer to your question, Kirk, is that I definitely have concerns. I mean, I had them back when I covered the sector from 06 to 13. And when I did, I had thoughts about what was going to happen to these companies then, and nothing has really changed that perception.
It's interesting. I think it's hard to change a trend when you've got so much invested in certain areas of the economy. It brings up the point, and I want to kind of pivot into the other area we talked about with you, Doug, next. But it kind of brings up the point of if people really want clean energy, there's really only a handful of sources right now that do that. Geothermal is one, which there are some major limitations in both the technology and the location. You've got natural gas, which is another, which of course is carbon, but it's cheap and it's relatively clean. And then you've got nuclear, which people don't want to talk about. And still, it's like politics. Like, nobody wants to dip their foot into nuclear, yet it is probably the best solution out of all of them that works and is scalable, and other countries are providing it. And to me, it's just ringing in my head, like, who's running the show here? Because you've got this technology that's available, that big money can be put into it and expand it and solve a lot of these problems, yet nobody wants to. So it leads me to believe nobody really wants to solve the climate problem. If they did, solutions are there. They all want to talk about the problem because it gives them power. It gives them power over our lives to direct where things are going and resources are going. And it's not about solving the problem. It's like politics. Politics is not about solving the problem. It's about politicians being important, so you need them. And realistically, we don't need them. We can all survive without politicians, but they need to be needed. So they create the problem, and then they don't create the solution. So I think that's part of the issue. But we want to get into the other area we talked about, which is really due diligence. So Doug, let me kind of tilt this back to you. I mean, we if people are looking at private investments, whether it's oil, gas, or real estate, or or any of the other areas that people have, how should people be thinking about due diligence? Because I mean, I don't know anything about oil and gas. I mean, I do, but if you showed me an oil well and say this is a good deal, like, I don't know, it's not what I do. It's not my expertise. So like, how should people be thinking about that process of due diligence when it comes to deals like this?
Well, that's a great question. I think, at the beginning of the conversation, Phil kind of summed it up a little bit in the fact that even if you do your due diligence, there is so many variables at play that are out of anyone's control, that, especially with regards to oil and gas and energy. You're talking about probably one of the most politically affected investment areas on the planet, right? I mean, besides the fact that you've got geopolitical forces coming in about whether or not we go with dirty energy, clean energy. You've got OPEC, who has got the cartel on 90%, or I don't know, I'm making that number up, of the supply that's out there, that's constantly, for their own benefit, trying to decide, do they increase production, decrease production in order to deal with those prices. Then you get into the effect, and this is something that's a little bit of a tangent that scares me a little bit, is that generally oil prices and economy have kind of been their own self-regulator, right? So if you get into a situation where oil prices become so high in demand, whether that's because of demand or because low supply, that prices, we've seen this before, where the price of barrels gets to a certain point, it becomes a breaking point to the economy, right? It tends to create its own headwinds, slow things down, reset things, bring the pricing down, et cetera. And at the same time, you get to the point where the economy is already weak. You get to a point in which, all right, demand has slowed, but now we're going to be able to get oil prices so inexpensive because demand is slowed that becomes an inexpensive way to begin to start to invest in again, bring that back up and into a warming economy. Well, unfortunately, some of these geopolitical ESG forces now have caused the prices of oil to go up a little bit. They've also caused the supply of oil to artificially decrease based on those forces at a time, and it wasn't necessarily in a recessionary environment that had that naturally do that. So if we're starting to see that production go down now during a positive economy, and then we shift into an economy that starts to degrade, and we're already have reduced production, I think that, again, that cycle, I think that's where we're going to start to see that a whipsaw, the bullwhip effect we've talked about, that could be, completely, drastic with regards to the long-term pricing of oil, especially once we start to come back out of whatever economic downturn we might end up being through some cycle, back into a rapid increase for demand. And now there's no supply there. And now you're forced to go the ESG route. And again, I think that the impact, especially to third world countries, could be significant. From a due diligence standpoint, to answer your question, listen, there's a reason they create accredited investment requirements, right, for a lot of these type of things, because there is a lot of risk that comes into play. As Phil was saying, I couldn't tell you what the future is going to be because of these impacts. And so generally speaking, it depends on your situation. If you are an extremely, extremely affluent, well beyond the minimum accredited investors, you're going to hopefully have a team of individuals that can be able to do the analysis, kind of like what Warren Buffett does with Berkshire Hathaway, right? He's got teams of people that bring him data to be able to determine whether or not this is going to be a good investment or not, and timing. And although it's rare, eventually it comes to the point in which Warren may decide he wants to sell something. But most people don't have Warren's resources. Okay. So if you're going to if you want to dabble in this and you want to get involved with it, the one thing I don't like, although it can still be a stabilizing factor of a traditional portfolio, but I tend to find that oil and energy is it's more of an alternative asset class, and alternative asset classes struggle historically to do what they're supposed to do in times of economic uncertainty and emotional investing. When you package these things into ETFs and mutual funds, and the average retail investor which we all know is emotional and behaviorally 101 is tends to be a challenge for them, that all of a sudden, while they're, we look at what the asset class might be poised to do from a correlation standpoint historically to a market portfolio, a lot of that can be thrown out the window when it becomes an ETF or a retail investment that has a secondary market to it, because all of a sudden you have something that should stabilize or perform well under certain environments that all of a sudden isn't, because people got emotional and they're either overbuying it or overselling it. And therefore, the prices you see in those secondary investments don't tend to work out long-term in the way that the data shows that asset class should, as it in a correlation to other things. So this is an area where I really do like more of the private investment. I do like, saying, look, this is a place, it is intended to be more of a buy and hold standpoint from an aspect of understanding how that correlated asset or that non-correlated or that, reverse correlated asset will balance things out with regards to all of the other investments you may have. But if you are emotional and just buying and selling based on the next bit of news that comes out, you get a bullwhip effect in the valuations of it that don't match or don't allow it to do what it's effectively supposed to do. And so this is why the private placement, I think, is a really powerful, really good place to play, is that you can put your money in something where you don't have as much control over making quick decisions. You allow that investment to be placed for a longer term focused, and then using, again, well, you may not have your own team investors like Warren Buffett does. You have a reputable company that does have the ability to watch these types of investments 24/7, to do the due diligence, to research, pull back the covers, see who's swimming naked, just staying on the Warren Buffett theme, and be able to be a little bit more pragmatic about when and where to deploy that money, which can shift very drastically depending on things that he talked about in the interview. Things like interest rates, things like monetary supply, things like recessionary, and slowdown in global economies, or just the fact that we do have a much broader global access to these types of things is now going to change the course of what the investments could do, compared to, say, maybe 20, 30 years ago, when the control of those types of investments might have been in more of a first world or Western world hands. And so therefore, I'm really a big fan in these type of investments of carving those things out, and definitely looking at groups that do this for a living 24/7, have a strong reputation that they've built up of understanding when to be patient and when to be aggressive.
Yeah, no, thanks, Doug. I appreciate that. So, Phil, what's I want to get your thoughts on this, and I actually wanted to add a little piece to this, which is the public versus private. Maybe you can kind of get into the pros and cons of that, because there's definitely some differences between investing in ExxonMobil and a private enterprise. So, what are some of your thoughts on that?
So, as far as public versus private, so the biggest difference that I always think of is liquidity, right? If I buy ExxonMobil, it trades on the New York Stock Exchange. I can buy it and sell it between 9:30 and 4 o'clock every day of the week. If I have a private investment, I can't do that. There's times that I'm allowed to buy it. There's times that I'm allowed to sell it. I have a client that she inherited some private real estate investments when her father passed. She doesn't want them. We tried to sell them. The fund said, you can't. We're not open for redemption right now. So you have to worry about that. You want to look at understand the fee structure. And I agree that there can be reasons to have the real experts in this, like Doug said, and this isn't an area where private investment can make more sense as long as you understand those constraints. But also you want to make sure, something that Ben talked about too, before you write that check, define what your investment goal is, right? What are the returns and the risks that you're trying to hit? Make sure that you have reasons that are justified, that it fits within your overall plan. Don't just do this without thinking about those things first.
Excellent point, by the way, to bring that up.
Yeah, absolutely. So we're going to wrap it up here. So, Doug, final thoughts from you?
Yeah, the final thoughts for me on this subject is, as I said before, I think it is an area that has many more forces against it that make it much harder to understand what the valuation is and when and how to invest in it. I think it's really important to look at it having a partner that's going to be able to have more access to that information. But like, Phil was saying, and like he said in it, understand, just like anything you're investing in, understand what your risk tolerances are, what your time frame tolerances are, what you can afford, because this can be an incredibly volatile area of investing. And those that typically go into this, they have a longer term horizon to be, and they have a liquidity. They're wise with their liquidity. They have the ability to be able to put their money into these investments for a longer term outcome. If this is money that you feel that you're going to need to create liquidity on in even a intermediate time frame of several years, I'd be very cautious about taking too much of your money and putting in this type of investment. It can be a fantastic differentiator and diversifier to other holdings that you might have. And in those regards, again, there's going to be times where it's going to be a miserable holding within your portfolio. But again, there is that old saying that we've talked about before, that if you don't dislike something in your portfolio, you're probably not diversified. So I think that people that understand that have the emotional competency to realize that not all things should be working necessarily at the same level of correlation, that not everything should be overperforming, so that you have that flexibility of something being able to help you when it works right. That might be a time that other things don't work. But if you understand your time frame, you understand your liquidity, you understand the power of investing in different types of things that may help you under all sorts of economic and political environments. And again, understand that this is one area that is highly manipulated with regards to geopolitical forces, and it is not going to do what you expect it to do many, many times. And because of technology, there may be things that come along that make what you're invested in highly obsolete and potentially permanently obsolete. And as long as that's the case, I think it's an area where I think it's important to hold, but be very, very cautious.
Great. Thanks, Doug. And Phil, final thoughts from you.
So I agree with everything that Doug just said. And I just would add one more thing when you're making an investment in this area. And it applies when you're making any investment, but I think particularly in this area, because of some of those constraints, is make sure you know who the jockey is, right? Who's running the company? Who's the manager? What's their track record? I know past performance doesn't guarantee future results, but it gives us something to go on. So make sure that you understand who's in charge and understand their philosophy, their approach, and what their record of success or failure is.
Awesome. Where can people find more about you, Phil?
My firm is Apprise Wealth Management. My website is apprisewealth.com. I blog every week. You can sign up for my blog from my website. I blog on all kinds of financial and financial planning related matters. And then you can get my ebook at apprisewealth.com/ebook.
Great. Well, thank you both for coming on. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.